Hey, what's up, everybody? All right, so I wanted to make this quick part 2 to yesterday's video. And what sparked this was got some really good feedback on the video. And a friend of mine, Chris, who I haven't talked to in a while, what's up, brother? Thank you. Asked me a really thought-provoking question yesterday. And it just kind of got my mind kind of spinning, and it kind of inspired this part 2 today. All right. So Chris's question was, in the video yesterday, I shared a couple of charts where I was saying that over time, the value of the homes, right, the price appreciation grew faster than the income that you received, right? So there's a delta there. So from 2000 to today, the price of a 2 to 4 unit multifamily in Fall River went up 450%, whereas the rental income only went up 160%. So it's like 3 times more expensive for the same income as it was in 2000 to today, right? Relative. So what would that look like? Chris's question was, if the rent went up at the same rate as the property, what would the rents be? Or if the property only went up the same rate as the rents, what would the value of the property be? Right? Which was interesting. I hadn't really thought of that. So I did the math. All right. So from 2000 to today, if the price of the house only went up 160% like the rent did, right? So they went up, if these two lines converged and there was no gap between them, right? The houses would only be $300,000, right? If the rent went up as fast as the houses did, right? If it kept pace and the blue line was also 443%, then the rents would be $3,600, right? So that's crazy, right? And it works on any time frame, guys. These are just percentage returns, right? So if we go back to this 2019 chart that I showed where the buildings were up 130% and the rents were only 63%. So a 2-to-1 delta over the last 7-ish years, same thing, right? If the houses went up the same as the rent, would be $450 for a house. And if the rent went up the same as the house, it's $2,500, right? So it's just starting from that starting point of whatever the rent was on this chart at that time, right? So it kind of brings me down to the next question, right? Is like, why do home prices go up faster than rent? And there's the proverbial rabbit hole that I went down. And we're here today doing this video because of that, right? So it comes down to assets and income, guys, right? So, you could have less income, but accumulate a lot of assets and your life will have one path, or you could focus solely on income and never accumulate assets, and your life could take an entirely different path, right? Same person, different priorities, right? So let's look at that and see what that means, right? So rent needs income, okay? So the blue line on these charts, which is the rent over time, needs income, okay? So you can only charge as much rent as there is income to pay it in any given community, any given town, any given city, any given state, any given country. That's why New York City rents are higher than Alabama rents, right? I mean, I think everybody knows this, right? Like, a 2,000 square foot apartment in New York City is going to be exponentially more expensive than the 2,000 square foot apartment in Alabama. It's just the amount of income that's in the community, the amount of demand. If all that income leaves the community, well, that has downward pressure on rents, right? Now, asset values are exploding right now, as we saw, right? That's the orange line on these charts, right? The orange line on both of these charts is just going up, right? So that begs a couple of questions. Why? And are you really getting richer, right? So I say, what we can see here is that asset values are growing much faster than the underlying income. So choose your own adventure in life. If you choose assets over income, your life is going to look one way. If you never accumulate any assets and just focus on income, your life is going to look a different way. In my entire investment thesis, all these videos I make, everything I do comes back to assets, to me, are more valuable than income. I generate a certain amount of income in my business and my life, but my goal is to accumulate as many assets as possible. And it's based on 2 things that I really think are inescapable and we can't change, right? The first one is this chart that I show all the time, and this is the U.S. national debt, okay? It is almost $39 trillion, okay? We are running a deficit of $1.7 trillion every year. I've shown this chart many, many times over the years, and every time I show it, it goes higher and higher, all right? And the second thing is money printing, okay? And you hear this term all the time, money printing, money printing. So let's get into it. Let's look at some charts, and I'll show you what I mean. So let's get into some charts. I made some charts that show these two things. So these charts, today we're going to start at January of 2020. Okay, so we're going to start back in January of 2020. So what? Put your thinking hats on. And what happened right after January of 2020? Okay, what was going on in the world at that time? What happened, right? So from January of 2020, so this pink line is government debt, okay? Which is this right here, this number, okay? Since January of 2020, government debt has went up almost 67%, okay? This number is 67% higher today than it was in January of 2020. And you can see the spike right here. That's the pink line. You can see this spike, guys. What did we do during COVID? $7 trillion. Okay, we sent everybody $1,200 checks. We had PPP loans. We had all this stuff. Okay, and the purple line is money printing. Okay, so that's where the government creates cash. So if you look at both of these lines since January of 2020, okay, 67% increase in government debt, 47% increase in money supply. That's the purple line. Now you can see in 2022, they try to do some quantitative tightening is what they call it. They try to reduce the amount of money in the supply, and they pulled it back a little bit, but it's off to the races again. And you can see government debt has been exploding again. And it's right here too. We run a deficit every year, guys. Right now we're running a $1.7 trillion deficit. Okay, that's just how government works. Now let's look at wages. All right, so this green line is wages since 2020. Now you remember I said, right, you need income, rent needs income. Okay, so without a lot of income, it's hard to get a lot of rents. Rents can't grow if there's not enough income. So this is a national measure of wages in the United States of America. And it looks great, right? You look at that line, you're like, wow, bro, 34% in 6 years. That's like almost 5-6% a year. People are growing, straight line up. But do you feel richer? Ask yourself for a minute. Are you making more money than you've ever made? And do you feel like you're getting anywheres? You know, because let's throw the rent on here really quick, right? Because we showed this yesterday. I mean, rent has gone up twice as fast almost as wages, right? Like, so something's got to give, right? So there's all this amazing government data, and let's throw it on here, all right? So these black lines are all measures of inflation, okay? So I'm going to throw 4 black lines on the screen. The first one is CPI right here. So these are all government numbers, government data, take it how you will, okay? But the CPI cumulatively, the master inflation numbers up 26% since January of 2020. Medical costs, this one down here, the CPI med is up 16%. All right. Transportation, 29%. Food costs, 32%. So you're making 34% more money than you were January of 2020. Your wages have gone up, but so is every other thing. All your other expenses, right? Your rent is more than doubled. I mean, your rent is grown almost twice as much as your income. So all these factors are working against income, right? And as much of a strain as there is on income means that the rent can't go up, and the and the things that you want to buy, you're not getting ahead. You're just trapped. So you're making more money than you've ever made, but you're trapped, right? So what about the assets, right? Now let's throw the assets on here, okay? So we threw on here yesterday, this is the 2 to 4 unit buildings. So you can see the assets are doing better, right? The assets are doing better. This is single family houses in Fall River. Let's do the yearly one, sorry. So these 2 orange lines are the prices of real estate in Fall River over that time, okay? The top line is 2 to 4 unit multis that we showed yesterday. This other orange line is single family homes. Okay, so you can see homes are outperforming, right? But they're getting unattainable because they're growing faster than the income. But that's what happens when you have poor economic policy, when you have this growing 66%. When this number goes up 66% since 2020, guys, that's what happens to assets. Assets go up. That's my investment thesis, right? As long as this pink line and this purple line keep going up faster than this green line, you need to get assets. You need to get assets, okay? The benchmark of all assets, right? The thing that we measure by, S&P 500. That's this red line. I'm gonna start throwing some benchmarks on here to show you, okay? So if you had just bought S&P 500 from January of 2020, which is the number that all investing is measured against, you did good, right? There's no 20% down. There's no bank involved. There's no high barrier to entry like buying a house, right? You just put $5 a day, $5 a week, $100 a week, whatever. In the S&P, at least you have some assets that are helping you offset the loss of wage purchasing power, okay? What if you went to the Nasdaq, the QQQ? I mean, that's tech, guys. Tech has exploded in the last 6 years, okay? 183% right there, okay? What if you just did the Dow Jones? Well, the Dow Jones, you know, those are the industrial companies, the big ones there, still up 65%, still beat wages. What if you invested in bonds? Okay, bonds are down here at the bottom. You lost money. You lost 10% because bonds are based on government's ability to repay them. And when the world looks at these numbers where our debt is exploding 66%, where our money supply is exploding 46%, they don't want our debt. They don't want to own our bonds, guys. You know, so what does money supply really mean? This purple line. I know this chart's very busy, but it's, you know, I tried to color code it and kind of, you know, make the point for you guys, right? Money supply in America, our biggest export, we're the world reserve currency. That's our biggest export. We export our money, okay? So when we need things, we print money. We export our dollars and we import oil. We export our dollars, we import iPhones. We export our dollars, we import Wegovy, right? We export our dollars, we import Air Jordans, whatever. All the things that we need are manufactured overseas. That's when you're the world reserve currency. You export your money. The problem is, as this number, this purple line goes up over time and your debt goes up over time because you need to go into debt to make more money to print, what happens, guys? You start to lose your foothold on the world. But if you look here, all assets, okay, orange is our real estate benchmarks, all right, the Nasdaq, S&P 500, even the Dow Jones outperformed wages, okay? So assets, in a time where government debt and money printing is getting out of control, owning assets, you will win long term. But are you really getting richer? Because the value of those assets is still denominated in a dollar that is losing purchasing power and losing value across the board. So that's just something to think about, all right? Now, my two biggest things that I talk about all the time are Bitcoin, which is this orange line here that totally dwarfs everything, 854% since 2020. And even after this big drawdown since October, right, where everyone's like, oh, it's down 50%, that's okay. You're still outperforming over time, guys, over time. And of course, Tesla, right? So there's Tesla. Over time, Tesla, Bitcoin perform well, okay? So that's it, guys. That is, that was the rabbit hole that I went down. Very interesting to me, and seeing how the price of the assets is growing faster than the income that they generate. I mean, it's black and white, guys. You got to get assets. And never in history have we had the ability where the barrier to entry to asset accumulation is so low, right? A Robinhood account costs nothing to set up. You can put $1 a day and buy some of these assets that we talked about today. Okay, you don't have to jump right into a house. And that's my point that I try to make all the time on here, is just to show people, like, look, there is a way to get ahead. It's not insurmountable. You can buy assets that are outperforming, and the barrier to entry is literally $1. All right, guys. So hopefully this was eye-opening. Thank you, Chris, for asking that question to me yesterday, because it kind of sparked this whole thing in my brain and took me down this rabbit hole. All right, guys, have an amazing weekend. It's going to be beautiful on Monday. Talk to you next week.